We've seen recently people getting worried about a drop in financial markets of 3 or 4%, but did you know it's a very real possibility that markets can drop by a much more staggering amount, such as 50%? And the reason I say this is that it's all happened in the past. According to traditional financial models, a drop of this magnitude in the S&P 500 index is practically impossible, and yet it happened in the global financial crisis of 2008. Nor was this the only time. The crash in 1929 was even worse. In this video, I want to explain a bit more about why estimates of the risk in financial markets are often wildly wrong. There are three main things I want to tell you about here. Reason number one is what Mandelbrot says about markets. The best way that I can think of to really give this a little bit more legitimacy is to tell you more about the inspirational work of the famous mathematician Benoit Mandelbrot. A lot of my interest in the behavior of financial markets comes from Mandelbrot, and in particular his work to do with fractals and chaos. His work is amazing and really game-changing. It's a very different way of thinking about statistical analysis of financial markets and, as far as I can tell, still isn't really widely understood by many people giving financial advice today. Mandelbrot points out that many financial market models are built on the Gaussian distribution, which is the mathematician's name for the normal distribution or the bell curve. Doing so assumes that large price movements are rare and catastrophic events should almost never happen. But Mandelbrot notes that the seemingly improbable happens all the time on Wall Street, with the example of a 7.7% drop in a day being quoted by him as having a probability of 1 in 50 billion, according to the bell curve model. If we go to Wikipedia and look at the list of biggest declines in Wall Street history, we see that this has happened 15 times, 3 of which were in 2020 alone. Not quite such a rare event then. Mandelbrot talks about how traditional finance fails to account for what he calls wild randomness. It's the kind of unpredictability that saw the 1929 crash, the 1987 crash, or even more recently, the 2008 financial crisis. Mandelbrot's work shows how you need to instead use fat-tailed probability distributions to accurately assess financial market risk. But what are fat tails? If you imagine a bell curve, the tails on either side represent the likelihood of extreme events. A fat-tailed distribution is one where these tails extend much further out than expected by a bell curve. This is effectively saying that the likelihood of reaching some extreme value is much higher than expected from methods based on simple bell curves. Now this brings us to my next point. If what Mandelbrot says is really the case, why is the normal distribution so ingrained in financial modeling? Well, it's mainly for reasons of history and convenience. The normal distribution is mathematically neat and tidy and makes solving equations that you might use to estimate the risk of a portfolio much easier. Put simply, it's easier to get your head around. But it's also theoretically appealing because you only need to make one assumption to allow you to be able to justify the use of a bell curve. And that's that price changes are effectively random and independent of each other. What this assumption does is allow you to then use a clever piece of statistical theory called the central limit theorem. This says that regardless of the original distribution of these variables, the distribution of samples, or the price movements in this case, will tend to follow a bell curve as the sample size becomes larger. The central limit theorem therefore implies that the sum or average of asset returns over time, for example, daily returns averaged over a year, will tend towards a normal distribution. And indeed, this approach makes for a good approximation a lot of the time. You've probably heard the saying, "Don't try to pick the market." Well, this bell curve approach aligns neatly with that idea because you're treating price movements as unpredictable and effectively random and independent. And this leads to another commonly used tool by financial market analysts, the efficient market hypothesis. This hypothesis suggests that prices on the market already reflect all the available information. So there is no further information by which you could anticipate future movements. For all intents and purposes, movements can't be guessed and are assumed to be random. They can then be modeled as following a random walk. That's why the efficient market hypothesis is so popular with some in the financial markets industry, because it simplifies things so much and conveniently fits with many of the narratives about how you should invest. Which brings me to my last point. Bell curves don't fit for market crashes. So how come the mathematics of bell curves don't apply here? The problem is the assumption that price movements are independent of each other. Mandelbrot showed this is incorrect. He found that stock prices don't move in a well-defined series of independent random steps, like a bell curve distribution would suggest. Instead, they often move in wild, irregular jumps, which aren't easily defined by a simple, normal probability curve. And the largest price movements are often clustered together in time. Mandelbrot points out that under a random walk model, the probability of several steep falls within a short period of time becomes astronomical, something like 1 in a trillion. And yet there are many examples of this happening historically. Such consecutive runs of large movements are an example of clustering in price movements and are reasonably common. This is how, for example, the S&P 500 dropped by around 50% in a relatively short period of time during the 2008 global financial crisis. Observations of these sorts of behaviors are what led Mandelbrot to introduce the concept of fractals. Fractal mathematics is a much better description of the sort of structure that financial market price movements exhibit. And because of this, there is some small, short-term correlation between price fluctuations. While most of the time this is quite a small effect, some of the time it also explains why you get such unexpectedly massive market movement. The fact that the most volatile price movements are clustered together in time is a vivid illustration of how the assumption of independence of price movements breaks down in reality. And it doesn't require any mathematics to even see this, as this chart shows. And if this clustering occurs, then the central limit theorem no longer applies, and therefore the bell curve model also breaks down. Broadly speaking, Mandelbrot agrees with the idea that trying to pick price movements is not really possible for this kind of data, but his point is that risk is much higher than most models assume, and failure to estimate risk properly may result in potentially heavy losses, particularly when it comes to things like derivative pricing, but also for portfolio management. So to conclude, Mandelbrot called for a revolution in finance. He particularly warned of an overconfidence in financial models. He argues that the traditional bell curve models are far too neat and tidy. And this really opens up a new way to think about risk. Risk, according to Mandelbrot, isn't some neat little variable you can plug into a formula by measuring a standard deviation. Indeed, it's questionable whether the standard deviation is even defined for this kind of extreme data, as the standard deviation for some kinds of distribution cannot be validly calculated due to the extremely large values that occur as more and more samples are taken. Mandelbrot was groundbreaking because he showed we need models that embrace complexity, not oversimplify it. We need models that reflect the reality of financial markets as turbulent, unpredictable systems, much like the natural phenomena that fractals were originally used to describe.